Commonwealth Bank of Australia is one of Australia's top 4 retail banks and the market darling. But on a last close of $81.54 as of late September 2019, we issued a sell recommendation of $69.45. We acknowledge that the economic environment has changed since then. However, Australia has not yet witnessed a recession for over 28 years, and the structural headwinds faced by CBA are now magnified. CBA's growth has historically been driven by leadership in retail banking, comprising 50% of net interest income, but this will be its downfall. Following divestment of its wealth management and insurance arms, CBA's 17 times PE is unjustified in the retail banking sector. A weak housing market and record low interest rates are painting a bleak picture. CBA performed strongly during the housing market boom, but the 3% decrease in credit growth from the height of mid-2017 is threatening its key competitive advantage. Australia's cash rate has historically been above its peers, but now the tables have turned. Interest rates are falling, and the Reserve Bank of Australia is running out of macroprudential levers to pull. In this new environment, investors are blindly chasing yield as CBA's quality reputation and 5.6% dividend yield becomes more attractive. The market's positive sentiment has overshot CBA's fair value, resulting in a 37% premium at 2 times price to book. This is unprecedented for any bank, domestically and globally. This is why we issue a sell recommendation with a price target of $69.45 and a 15% downside. A competitive environment is expected to squeeze CBA's profitability. Cost targets are overly ambitious, and in this new world, the market has false hope of CBA's ability to return capital.
CBA is facing a challenging operating environment as increased mortgage competition and falling interest rates squeezes its net interest margin, or NIM. The recent downturn in the housing market has increased competitive pressures in the mortgage sector. Intense price competition has dominated the industry. Non-banks have been taking market share of the majors by offering interest rates up to 20% lower. The majors' market share of new housing loan approvals has fallen to a record low of 71%. As such, CBA has pursued aggressive discounting to defend its market share, cutting its standard variable rate by 148 basis points. With mortgages comprising 70% of CBA's loan book, its NIM is highly sensitive to home loan pricing, with our analysis showing that just a 5 basis point change in asset yields results in a 1.7% earnings impact. Now, these pricing pressures are particularly concerning for CBA's NIM, given the low and falling interest rate environment. With each further rate cut, the banks have less scope to reduce their funding by passing through the lower interest rate to depositors. Deposit rates are falling towards zero, and CBA's pool of rate-insensitive deposits is increasing faster than the other banks. We see CBA's NIM as the most vulnerable to compression, as CBA has the largest proportion of low-cost deposits out of the major banks. At the July rate cut, $160 billion, or 28% of CBA's deposits, were already rate-insensitive. These pressures will be further compounded by the additional 50 basis points of rate cuts resulting from the coronavirus crisis. With CBA being highly prized for its consistent dividend yield, falling earnings caused by a shrinking NIM means that in order to maintain its dividend, CBA's payout ratio must remain above 88% for the forecast period, which we see as unsustainable.
We now highlight a market underestimation of costs. Historically, CBA focused on ensuring revenues outpaced costs, known as positive jaws. Now, as we predict base revenues to fall 1.4% in FY20, costs would need to be cut 2.5 times greater to achieve what the market has priced in. Costs have built up 18% over 7 years. The Titanic takes time to turn. Even with recent attempts, its sticky base rose 2.4% year on year, yet investors are blindly following management guidance. Maneuverability in ATM and branch cost reduction is extremely low, delivering less than 1% of group savings and undone by occupancy inflation. Shrinking its core branch network is also misaligned with its competitive advantage, dependent on suburban customers. And in this COVID environment, cost challenges accrue, accentuated by income contractions. Amidst a backdrop of continuing compliance costs, program fees have been misleadingly labelled one-off, yet 30% of these are ongoing. We see 450 regulatory employees necessary for 2 to 3 years. The market has underestimated the longevity of these programs. Over 50% of external and internal targets have not even been scoped, not to mention regulatory IT updates required for 2022. Our analysis proves underlying expenses cannot be hidden by management for long. One-offs are here to stay, and we expect to see the market shocked by FY20 figures.
CBA's status as a market darling has been enhanced in recent months by its divestment program. The market expects these transactions to inject a full 110 bips, raising CBA CET1 to 11.8%, well above APRA's unquestionably strong benchmark of 10.5%. This has fueled a rally in the share price, as the market is pricing in a return of funds to shareholders. However, lessons from NAB, ANZ and Suncorp have shown that divesting a life insurance business in Australia is a complex regulatory task, particularly where the acquirer is based overseas. Similarly, CBA's sale of CommonSure to AIA Group was announced in September 2017 with an expected completion in 2018, which was pushed back first to August 2019 and is still incomplete. We expect an opaque Chinese approval process to delay the completion of BoCom Life and are unconvinced by CBA's pro forma CET1 forecast. However, there is a storm brewing in New Zealand. What was once an egregious proposal by the RBNZ to double its domestic CET1 requirement to 16% is without subsidiary repatriation is now a certainty. Our calculations show that ASB will need an extra $3.7 billion of Tier 1 capital to meet the requirement, leaving CBA 42 bips short of its 11.8% forecast. However, if we adjust for transaction risks, CBA will be left with only $318 million in excess capital. For an organisation still recovering from a slate of corporate governance shortcomings and having to dramatically increase its bad debt provisions in light of the COVID-19 fallout, our view is that a risk-averse board will heed the advice of the regulator APRA and take the most conservative route for capital management. This includes meeting the RBNZ requirements up front, thereby avoiding the risk of an equity raise down the line in what is ultimately an uncertain environment, one that Australian banks have never seen before.
We valued CBA using a blended approach consisting of the residual income model, dividend discount model, and relative valuation, and arrived at a target price of $69.45, which represents a 15% downside on last close. Sensitizing key value drivers such as the net interest margin, loan growth, and the cost to income ratio, we find that our bull case valuation maintains a 10% downside. Our regression analysis also finds that no other global bank is currently trading at 2 times its book. CBA's PE premium over the Australian majors is also at a record high, although its ROE leadership has declined over time. We have identified 2 material risks to our sell recommendation. Firstly, yield-seeking investors may continue to find CBA attractive in this low interest rate environment, but there are signs of weakness in dividend sustainability with CBA's high payout ratio, and find that even a 50-cent cut to dividends will reduce intrinsic
1 minute remaining
by $8.13. Secondly, CBA is exposed to recovery in the housing market, but we've analysed a wide range of housing credit growth trajectories and find that we will need to see an immediate, full recovery in the Australian housing market for this risk to materialise. However, this is unlikely given the weak economic outlook and the high levels of leverage in Australian households. In conclusion, CBA is facing pressures from all fronts. Its NIM will continue to be squeezed by further rate cuts. Management will find it difficult to reduce costs, and capital management initiatives are greatly overestimated. The best of CBA is in the past and is now simply not worth its price. We are from the University of Sydney, representing the Asia Pacific. Thank you for listening, and now I open the floor to any questions.
Okay, so let me just go first. I hope that's okay. Thanks for the presentation on a very technical industry. I want to understand a bit more on how you mentioned that investors, the one reason for the increase in share price was the high dividend yield. I want to understand more on how the dividend yield compares with peers, as well as how CBA's non-performing loans ratio asset quality compares to peers. So can you explain a bit on that? Thank you.
Yeah, I can take this question. If we move this appendix slide 108. So here in this slide, there's two parts to this slide. The first part is the loan impairment expense, and the second part is the dividend yield comparison. So at the bottom half of the slide, we can see that because of CBA's extremely high price, it trades at a 90% premium on a P on NTA basis to the other major banks. Its dividend yield is quite low. And the institutional part of CBA's shareholder base, the yield-focused ETFs, will magnify the movement away from its peers and towards CBA. I think Jess may be able to talk about the non-performing loans.
Yeah, sure. So CBA's non-performing loans have increased in the recent half as provisions from bushfires have increased. But if we turn back to appendix slides, and we go to slide 113. So we can see that in the recent half, the US banks have increased their loan loss provisions significantly. So we can see that Wells Fargo has undergone a 620% increase in their loan loss provisions. And this amounts to about an average of 0.3% of their risk-weighted assets. For CBA going forward, we do see a significant reserve build. So recently CBA has increased their provisions by 200 million. We expected this to be in the order of 1 to 1.5 billion. And we note that this is slightly lower than our US peers because CBA is less exposed to these unsecured credit card loans. That is more of a structural feature of US banks.
Okay, a question about trading liquidity. How much of the stock is owned by institutions versus individuals, and what impact is the sale going to have on trading liquidity?
I can take the first part of your question. If we move back to slide 108. So the graph on the bottom left there shows the proportion of retail shareholders. So it sits at around 55% for CBA, which is substantially higher than its peers. And given the dividend cuts that we are likely to see as an impact from the coronavirus fallout, the dividend cut will have a magnified effect on CBA's majority retail shareholder base. And in terms of trading liquidity, CBA is one of the largest stocks on the ASX, and its trading liquidity is extremely high. And so it is traded quite a lot. And given this current period of extreme market volatility, we expect it to be traded quite frequently.
I'll take this one. You based your analysis on deposit rates, on deposits. And you said that deposits are very, very low. In the current market conditions, we may see an increase of deposits. And deposit growth might be a good way of seeing flight to quality. So how do you assess this element to your analysis?
Yeah, sure. So we definitely acknowledge that CBA does occupy a leading position in the Australian banking market, and this is shown by their leading share of deposits. So 70% of their funding is through deposits. So we do acknowledge there is a potential risk for flight to quality there. But what we think is the mitigating factor there is, firstly, CBA's deposit rates are substantially lower than peers. So we see that CBA has an online savings rate of 0.5%, whereas the peers and the industry average is 0.85%. So this is one factor mitigating against a flight to quality in terms of deposits. The second part is that despite the a potential growth in deposits, we don't believe that this will materially affect our recommendation, because we believe that the structural headwinds owing to low interest rates on CBA's NIM will mean that any flight to quality in deposits will be offset by any earnings headwinds, particularly from our low interest rates, as well as our subdued and stagnant credit growth.
And just to add very briefly on that, when we talk about a flight to quality, we must ask ourselves what role banks have to play in a recessionary environment. Ultimately, CBA is expected to be a cushion from the fallout for consumers as well as businesses. There are other blue chip stocks on the ASX, infrastructure, CPI-linked toll roads and utilities that offer a similar dividend payout and are more relevant when we talk about a flight to quality.
Well, I'm going to step in now. I want to ask you about the liquidity gap of the bank. Usually in this kind of environment, banks see that the clients tap their credit lines. And I cannot assess from your presentation how well they are to fulfill the credit demand in a recession environment, and how balanced is this credit demand with the deposit base of the bank? I mean, is there enough deposits to face the credit demand, a growth in credit demand in a recession environment?
Sure, yeah. So I think in response to this question, CBA is very well capitalized. So firstly, from a deposit perspective, it has a very large base of low cost deposits. So we believe that if there is any like liquidity risk and credit demand, CBA is well placed to meet this. But secondly, the Australian banks are one of the most well capitalized. So there is a CET1 ratio, a tier 1 capital ratio of 11.5%. And this is one of the highest in the world. So we believe that if there is such a liquidity crisis, CBA is well positioned to meet any liquidity demands, both from a tier 1 capital perspective, and it also is well capitalized from a tier 2 capital subordinated debt perspective.
So there you don't see any need to go to the markets to raise some capital?
So there won't be any need to go to the markets to raise capital at the current moment. CBA has the highest CET1 capital in the world on a Basel III adjusted basis. However, if we look at it from a ROE perspective, given it has all this excess capital, this is really weighing on its profitability in the long term.
I have a question on NPL. Could you just elaborate on non-performing loans, please?
Yeah, sure. So Justice, if you flick to slide number 69. So we can see that for CBA, just to provide a bit of historical context, if you follow me to the asset quality section, you can see that the non-performing loans as a percentage of gross loans and acceptances has slowly creeped up over the last 5 years. This is because of pockets of distress in consumer segments in Australia, really due to the weakening economic environment. You can see in the most recent year in FY19, this is the non-performing loans as a percentage is at 93 bips, and we forecast that to slightly tick up in the next few years in line with increases on provisions.
Well, I have another question regarding other sources of income. I don't know how feasible it is to raise some fees or create a new ones in order to have some revolving and recurrent income, or if the Australian market doesn't allow for finding these other sources of income, especially in a margin compression environment.
Sure, I can talk about other sources of income very briefly. What's happened with CBA over the last few years is that it's divested the majority of its asset management and life insurance arms, which are the fee generating segments of the business. And essentially what's left with this business is a large book of retail and business-based loans. And when you compare that to some of its international peers that trade on a similar P on NTA basis that have sorts of investment banking revenues as well as sales trading revenues, the CBA really doesn't have the ability to diversify its revenue generation from that perspective.
And also, just to add on to that point, and thank you for the question as well, it's a very topical question, particularly when we're looking at Asian banks and their low return equities.
That is time. Thank you.
Thank you.
Thank you.
Thank you so much.
Thank you.
So that was University of Sydney with a sell on Commonwealth Bank of Australia. We'll now pause for a few minutes, let the judges take some notes before calling the second team.